Hello everybody and welcome back. This is Swati Gupta, Chartered Accountant. Today we are going to study International Accounting Standard 19, or you can say Indian Accounting Standard 19. These both standards can be studied together. The name of the standard is Employee Benefit. For full playlist in Hindi and English language and PDF notes, don't forget to check out the description box. Let's begin. Let's begin with understanding the applicability of employee benefit, that is Ind AS 19. Here it applies to all employee benefits except share-based payment. Such share-based payment is included in separate Ind AS, that is Ind AS 102. Videos in Hindi and English both are available for such explanation of share-based payment. You can check it out. Now, employee over here means what? It includes director as well. Okay, every employee, whether it is part-time, full-time, permanent or temporary, all nature of employees are included in employee definition over here, but it never ever includes contract labor in the definition of employee. Now, any payments given to employee are included under the head employee benefit, whether it is in cash or in kind, whether it is given directly to the employee or to its dependent. Okay, next, now the concept comes as that whenever you treat any employee benefit expense, either it will go to P&L or balance sheet. There are certain heads and names given. It is recorded under such terms whether it is in P&L or balance sheet. Under P&L, there are four important terms given: current service cost, that is CSC, interest cost, actuarial gain and loss, past service cost. These four terms are given. Any sort of expense related to employee will be recorded under such four heads, depending upon the nature of such expense, when it is arising, how it is arising, and how such treatment is defined under the Ind AS. Whereas, if it is of the nature, then it is recorded in the balance sheet, like benefit obligation, employee benefit asset. Whether if it is liability, then it will be recorded in the liability side. If it is any asset, then it will be recorded in the asset side under the head, under the balance sheet. Okay. Now, next, types of employee benefits. Okay, there are importantly four types of employee benefits. We'll read one by one and see what it has in it. Okay, what it has to offer, how it is defined, and how it is segregated from one another, how different treatments are done for each of them. Short-term employee benefit, this can be abbreviated as STEB, short-term employee benefit. Okay, now anything, any amount, any expense that have arisen, okay, and is payable on the balance sheet date, okay, from balance sheet date you will consider this, and 12 months, in this 12 months, okay. So within 12 months from the balance sheet date, if such expense is payable, if such obligation is payable, then it is termed as short-term employee benefit. I hope I am clear. Read this. All accruals of current year, either paid or if not paid, then due in next 12 months, are considered as short-term employee benefit. Okay, this will be considered when at the time of balance sheet date, closing balance sheet date, you'll see if such amount is payable in next 14 months, then it will be considered as long term. If it is payable in next 8 months, 10 months, 12 months, then it will be considered as short-term employee benefit. Okay, some examples are given like wages and salaries, short-term bonus, leave salary, profit sharing plan, non-monetary benefits, others. Okay, next comes long-term employee benefits. This is second type of employee benefit. Now, from the balance sheet date, this is from the balance sheet date, you will see if such amount is payable after 12 months. See, after 12 months from the balance sheet date, okay, then this will be considered as long-term employee benefit. Okay, earlier we discussed if it is payable in next 14 months from the balance sheet date, then it will be considered as what? Long-term employee benefit. I hope I am clear. Read this again. The current year accrual not paid in current year and not in next 12 months but paid after 12 months from the current balance sheet date. Okay, this will be termed as long-term employee benefit. Some examples are given like long-term bonus, gratuity, PF, ESI, etc. Next comes post-employee benefit. okay, post employment benefit. This is done at the time of retirement or after retirement, okay, when somebody is retiring at that point of time or after the retirement, any such payments are given, then these are termed as post employment benefits, okay, any accruals paid at or after retirement. Example, all contractual payments, legal payments, formal, informal payments, anything, okay, that has been dealt or promised beforehand. Now, next and fourth type of benefit comes, that is termination benefit. This is when the employee himself takes resignation and voluntary retirement, or the employer removes him, okay, or terminates his employment. Then in both the cases, any benefits that are given can be termed as termination benefit. It means employer decision to terminate the employee and employee decision to take voluntary retirement. Both are considered in this termination benefit. This benefit may be settled in 12 months or may be settled after 12 months. This both can be the situation 1 and situation 2. So for both of these, different treatments will be done. If it is within 12 months, then it will be treated as short-term employee benefit, sort of. And if the payment is done after 12 months, then this will be treated as sort of long-term employee benefits. There is a summary chart given for all 4 of these benefits. We'll discuss right now. Accounting background for each of them. First, we studied short-term employee benefit. This was payable within 12 months from the balance sheet date. Now, accounting will be done on non-discount basis, okay. Any discounting is not needed. It will be done as and when it occurs on the same price. No actuarial techniques required, no actuarial gain and loss required, okay, arises. Very simple accounting, basic accounting, okay. Whereas if we talk about LTEB, long-term employee benefit, that is payable after 12 months from the current balance sheet date, then this will be accounted on discount basis, that discounting will be done, okay. It requires actuarial techniques and complex accounting. Why? Because there are number of years involved, and here present value factors come into place. The amount gets inflated or might get downwards, okay. So such calculation difference might occur in long-term employee benefit case, okay. Post-employee benefit also after 12 months, then this is also treated as discount basis and complex accounting is done. Here also actuarial gain loss can arise and actuarial techniques are applied. Now, if you are clear about this 3, fourth one comes as termination benefit. This can be 2 ways, either in 12 months or either after 12 months. If it is within 12 months, then it will be treated as STEB, short-term employee benefit, and the treatment will be simple accounting. Whereas if it is done after 12 months, then there will be actuarial techniques required and it will be recorded as long-term employee benefit, sort of, and complex accounting here is taken into accounts. Now, short-term employee benefit, some entry is given, journal entry, which will make the concept more clear. All STEB, short-term employee benefit, accounted on undiscounted basis. Example, short-term employee benefit expense debit to cash or benefit payment. Treatment of expense, employee benefit expense, if it is related to asset, then capitalize it, other case transfer it to P&L. Leave salary, very important, okay. At times what happens is, the employees are given paid leaves, okay. Even if you take some authorized leaves, some certain level of leaves, then any deduction from the salary is not done, okay. These are known as paid leaves, okay. For at times, if you accumulate it or you collect it, what does accumulation over here means? Because your concept will come. Accumulation generally means collecting the leaves, okay. Collecting, ikhatta karna, collect karna, okay. So at times the companies allow them to collect their leaves, okay, pile up leaves, and then take benefit of it. Either take leave in place of such leave, okay, one day that there was a holiday but you still worked and did not take a holiday, okay. The employer might offer you that you can take a leave some other day whenever you require such leave, okay. It can be one case. Other than this, what happens is, it might be that whatever leaves you have collected, you can encash it whenever you want or when you are leaving the organization, as the case may be. Okay. Other than this, one more case that can arise is that accumulation is not allowed, where either you take the leave when it is given, okay, otherwise it will get lapsed and you will not get any added benefit or carry forward benefit. Okay. So accumulation basically means what? Collecting the leaves. So if accumulation is not allowed, then no accounting is required. Okay. Ignore, no treatment required. But if accumulation is allowed, collecting of leaves is allowed, then you have to see if leave not accumulated. Okay, there is a person who loves to take holiday. Okay, whenever he gets a leave, he takes the leave and enjoys it. Okay, and never tries to accumulate, even though there is a provision that the employee can accumulate such leave. Okay, if not allowed, no treatment. If no leave accumulated at all due to any reason, then also no treatment required. Now important part comes, that when accumulation is allowed and the accumulation is done as well by the employee, then you see vested leave. Vested leave means, in short you can say, in simple words, entitled leaves, that you are entitled for it. And unvested leave. A vested leave means you can encash it, you can take cash for the leave, whereas unvested leave means leave for leave, that you can take some other day as off in place of such holiday on which you worked. Now in case of cash for leave, that is vested leave, entire payment is recognized as expense immediately, whereas if it is leave for leave, then provision is made. What is the difference? If cash is given, if entitled to take cash, then recorded it as expense, but whereas leave is given in place of leave, then you make a provision. Examples are given. For example, A Limited allow annual 30 days accumulation of leave. For accumulated leave, A Limited pay cash. Okay, this is vested leave. Cash is given in place of leave. To daily remuneration. Daily remuneration average per employee is rupees 700. In current year, 100 employee accumulated average 11 leaves. 100 employees took 11 accumulated leaves. Okay, so 100 into 11, and per employee per leave they will be entitled for a cash of rupees 700. So what will be the expense? It will be recorded immediately as an expense. See, cash for leave, record as expense immediately. So employee benefit expense, that is 100 into 11 into 700. Okay, it comes 7,70,000 to bank account. It will be paid off. Next examples come as leave for leave. A Limited allowed 10 days sick leave and 5 days of privileged leave. A Limited has 1000 employees. All employees accumulated 3 days sick leave. Okay, out of 10 they took 3 days sick leave accumulated. Okay, and 1.5 days PL, that is privileged leave. Out of 5 they saved 1.5, out of 10 they saved 3 days. Okay, so in total they are having 4.5 leaves. Leave can be carried forward for next 12 months only. A Limited has policy to allow leave for leave. Okay, this is unvested leave, leave for leave. From past practice, it is observed that employee will not exercise more than 2 days sick leave and half days PL if daily remuneration averages 800. In actual, what happened? Only 2.5 days have been accumulated, and at the rate rupees 800 is payable. There are 1000 employees. Good. See, number of employees 1000. The leave accumulated is 2.5. Okay, this becomes, if you multiply this, 2500 days. Remuneration is rupees 800. This comes to a total of 20 lakh. Now what we have seen, if such leave for leave is available, unvested leave is there, then you make a provision. Employee benefit debit to provision for employee benefit. You make a provision. Whereas in case of cash for leave, you made instant payment and recorded it as an expense immediately in the P&L. Next comes profit sharing plan. Under profit sharing arrangement, employees are paid a percentage of profit. Okay. In this case, entity shall create provision for profit sharing plan to the extent of amount payable. provision is required and a percentage of profit will be payable. Let's understand this with an example. In the year 2020-21, A Limited announced that employee will be paid under profit sharing plan. As per beginning estimate, it is expected 6% of the profit will be paid to employee attrition. Attrition means removal. Okay. At year end, it is estimated only 4% will be paid. Okay. So 4% has to be paid. Profit kitna hai? Profit is 10 crore. So 10 crore into 4% will be made provision. We'll make a provision 10 crores into 4%. Now comes different terms. Okay. Bonus plan. Bonus shall be accounted only when, very important, only and only when the employer has constructive obligation or legal obligation to pay bonus. Okay. For example, the manager or the upper committee decided, let's pay a bonus. Okay. Out of no such obligation, they willingly decided, okay, let's pay bonus or let's pay Diwali bonus, anything. Then such amount will not be recorded or accounted under this Ind AS. It will be recorded only and only when they have to pay bonus. Okay, it was under some contractual, legal, any sort of obligation, and then under that they have to pay bonus. If such case is there, then such accounting will be done. Okay. Bonus will be recorded and accounted only and only when there is obligation to pay such bonus. If any voluntary bonus is given, then such accounting will be not done. Non-monetary benefits means any benefit that is given in kind, okay, other than cash. Now, such benefits will be recorded at fair value, always at fair value basis. Reclassification. At times, short-term employee benefit can be reclassified to long-term benefit, employee benefit, when two conditions can arise. First, terms of payment has been revised. For example, the terms are revised. Now you have to pay not within 12 months, you can pay in next 15 months. So now it can be reclassified from short-term to long-term. Okay, if the terms and conditions are revised. Or contract is classified as accumulating from non-accumulating, especially in case of leave. Okay, now the contract has been changed and accumulation, that is collecting of leaves, has been allowed. Okay, if such change is made in contract or the terms and conditions, and then it says that now it is of the nature and characteristics of long-term employee benefit, then such short-term employee benefit can be reclassified to long-term employee benefit. Next, disclosures. No separate disclosure requirements under Ind AS 19, but however, disclosures can be made under Ind AS 1 and as per Ind AS 24. But such 19, Ind AS particularly 19, does not require any such explanations and disclosures. Next comes post-employment benefit. Okay, there are two types of post-employment benefit, that is defined contribution plan and defined benefit plan. Even I have made a YouTube short for it, explaining it in a very simple term that what is the difference between them. Most of the time people get confused in it. Okay, now defined contribution plan means there is no such actuarial gain loss or any adjustments happen. The employer does not have to bear any such extra payments or the risk. Okay, it just have to deposit the particular amount that he is asked for. He just have to limit his obligations up to the contribution that he has asked. And the PF, okay, if he is asked to pay, for example, 10%, then his liability is just to pay 10%. Okay, there is no additional actuarial gain loss or other liability or obligation of the employer. Whereas in defined benefit plan, the obligation of the employer is not just limited to the contribution, it is limited up to the final benefit payable. Okay, the day when it will be finally paid, and the payment over and above, if he has to pay, will be bear by the employer. The employer have to bear such additional payments, the actual gain loss risk. Okay, see, read this. For example, any gratuity. Okay, you have to pay gratuity, and if it is more than the estimated one, then the amount that is payable have to borne by the employer. All the risk has to be borne by the employer. Read this, you'll get it. Okay, in this case there is simple accounting, whereas in defined benefit plan there is actuarial techniques are applied, and therefore there is complex accounting. You can read this, you'll get a better idea. Now, accounting for defined contribution plan. Okay, any payment made is accounted as expense. Okay, directly it is recorded as expense. If payment is made but benefits also consumed, then it is considered as expense, no doubt. If payment made but benefit not consumed, then this is prepaid asset. This is on the basis of general rule that you have learnt in 11th standard. Okay, the basics of accounting. Make sure the basics of accounting, you're never forgetting that. Okay, whatever level of language or accounting treatment you learn, the basics will remain same, and that will help you throughout. The payment, if it is not made but the consumption of benefit has been done, that you have received the services but still the payment have not been made. If such is the clause, okay, such is the situation, then it will be considered as outstanding liability. I don't think there must be any doubt. Journal entry will be employee benefit to contribution paid or payable. Contribution payable, if any, is accounted on undiscounted basis, because there is no actuarial gain loss or techniques applied. Amount recognized as expense under contribution, these disclosures are required. Disclosure of contribution plan to KMP means key managerial person under Ind AS 24. I told you that Ind AS 19 does not require separately, but Ind AS 24 requires it, the disclosures. Defined benefit, if we talk about, example given, A Limited provides following information for contract with employee about retirement benefit plan. Now the whole amount is not considered as expense within 1 year. Instead, it is divided across the year. Okay, if 7-year benefit is there and the amount is divided in 7 years and transferred to P&L. Okay, benefit payable is 20% of final salary for each completed year of service. The retirement period is 5 years. Current salary is 10 lakh. It will grow 8% per annum. Okay, so 10 lakh, then 10 lakh plus 8%, then plus 8%, then plus 8%. Okay, this is how. So first, your salary, projection of salary will be 10 lakh into 1.08 done for the 4 years. First year is 10 lakh, and then 4 years it will grow by 8%. So here comes 13,60,000 at the end of 5th year. Now, this is the amount that you will be paying of such. Okay, this amount is the salary, and of this you will be paying 20%. Here it is given in the question, benefit payable is 20% of the final salary. So final salary at the end of 5th year will be 13,60,490, and of which you have to pay 20%. Okay. Now, unit benefit, yearly benefit will be divided across 5 years. They won't be recorded in one particular year. Accounting of defined benefit plan, actuarial assumptions are taken. Okay, actuarial techniques are applied, required to measure the obligations and expenses. There is possibility of actuarial gain and loss. Obligations are measured using discounted basis. Here discounting is required. Complex accounting is done. Actuarial assumptions are what? They are simply the entity has best estimates of the variable that will determine the ultimate cost of the variable providing post-employee benefit. It has taken best estimate. Simply, whatever estimates they are taking, like for example, they took 4% instead of 6%. We assume that the assumptions that one is taking is well proved, predefined, has evidences, and are best estimates. Actuarial assumptions shall be unbiased. There should be no partiality and mutually compatible with the organization's accounting behavior. Actuarial assumptions are unbiased if they are neither imprudent or nor exclusive conservative. Okay, they are considered as unbiased if they are neither very aggressive or neither very conservative. They must be unbiased and moderate. Actuarial assumptions are mutually compatible if they reflect economic relationships between factors such as inflation, salary increment rate, and discount rate. They are considered as very much what? Best estimates. Okay, mutually compatible if they keep into mind, they keep into consideration the inflation rates, the a salary increment rate, etc. Like in the before example, just before example, there was 8% increment every year. Okay, we kept in mind, okay, that 8% included. There might be any inflation, there might be any discount rate. If it is considered, okay, and made and adjusted according to such particular organizations variables, then it is known as compatible. Okay, mutually compatible. Actuarial assumptions consist of demographic. Okay, demographic means any mortality rate, the kind of population, okay, the kind of population, mortality rate during period employment, after employment, rate of employee attrition, the number of people that are leaving the organization, disability, early retirements, change in plan number of dependent, claim under medical care. These all are included under demographic profile. Okay, the constitution of the population, the kind of population, the characteristics of population around it, the employees. Okay, and financial, like discount rate, salary, increments, inflation, tax payable, these will be considered under financial assumptions. Now, assessment of discount rate. Discount rate shall be inconsistent to market yield. It should be consistent to market. Okay, the market that the market returns, it should be considered consistent with the market returns. On government bond, that is risk-free one, subsidiary, associate, joint venture and branch outside India, then discount rate shall be high quality corporate bond rate. If it is outside India, if it is foreign one, if it is foreign branches, foreign subsidiaries, then the rate will be taken from high quality corporate bond rate. If it is within India, if it is domestic, then it can be taken off government. If it is outside India, then we have to take high quality corporate bond rate. If high quality bond corporate rate is not available, then use rate of that country. That particular foreign country rate can be used. If selection of discount rate in actually must consider other factors as well. We have seen demographic and financial factors, assumption, they have to consider such factors as well. Accounting of defined benefit plan. Accounting depends upon types of benefit, like benefit may be funded or unfunded. Funded means what? Funded means a backup asset has been parked whenever the obligation arises. Such assets that have been kept separate will be liquidated and such obligation will be met. Whereas unfunded means you are not prepared, you have no such backup or assigned asset. Whenever the obligation arises, you will be dealing with the obligation there and then. Okay, there is no backup planned. If planned, then funded asset. If no such planned asset is available, then unfunded asset, non-funded asset. Okay, funded benefit means obligation with plan asset, unfunded means obligation without plan asset. Accounting of liability of DBO, defined benefit obligation, and asset plan shall be evaluated separately. Okay, the separate evaluation will be done of the obligation and the asset. Accounting of liability, that is defined benefit obligation. Calculation of CSC, current service cost, interest cost, closing obligation under PUCM. Okay, what is PUCM? PUCM is planning under a corporate mandate. Each period of employee service gives rise to additional unit of benefit, and such units are measured separate and added to final obligation. PUMC means every period there are additional services are given. Okay, such amount that is additional is added and then added to the final obligation, and there how the final obligation estimate can be taken more appropriately. Impact of any change, if there is, okay, of the actuarial assumption, then that will also be taken into consideration. Impact of any modification that has been done in the terms and conditions or revaluation, anything. Okay, reclassification, we have seen terms of employment, any changes done in actuarial assumption, we will consider that. Any changes done in the contract, okay, or terms and conditions, then that will also be considered. Impact of curtailment means stopping or settlement of benefit payable. If any such situation arises, impact of such activity will also be taken into consideration. Payment of liability at the age of retirement. Okay, we will be calculating the age, the remaining age, and then we will consider when to record it and when not to record it. Application of projected unit credit method. Okay, this is a formula given whenever any question is given, you can follow this method. Firstly, estimate the final salary. Okay, 10 lakh was the salary and 8% it was growing for next 5 years, and then we took as a 13,60,000 approximately. So this is what final salary, 13,60,000 approximately. Calculate benefit payable. Okay, like there was agreed rate 20%. So final salary 13,60,000, agreed rate 20%, number of years there were 5 years. Yearly benefit, total benefit divided by number of service period. Calculate current service cost. Each year such amount will be transferred to P&L. Yearly benefit. Okay. Calculate closing liability and interest cost. If there is any hidden cost due to non-payment or delayed payment, then such interest cost factor will be considered and calculated separately. Next, analysis of allocation of CSC, that is current service cost, that is benefit allocable. For example, an employee joined an organization when he was of the age of 25 years. Now the organization or that company announced that there will be benefit given to employees when they are of the age of 35, and it starts from 35 and it will be given at the age of 55 when he retires. Okay, so such accounting will not be held unless it is vested. Okay, here no accounting is required. Whereas from the year 35 to 55, in this 20 years, such expense will be divided and allocated. Okay, employee having age 35 or more are covered in retirement benefit plan. So for these 10 years, there will be no such accounting required. Service cost of retirement benefit shall be allocated only when following conditions are satisfied. Employer obligation for benefit plan has arise. Obligation has arise. Employer receive benefit of such obligation from employee. If such benefits have been received and still the payment is pending. Okay. It is to be noted that service period not covered in retirement plan benefit shall not be contributed to the period of service. Now, analysis of allocation of CSC, benefit allocable. Okay, for first 20 years, it will not be done. Another example is given. And for next 30 years, from which point he is now eligible. Okay, he is now eligible. Okay, for these 30 years, the allocation of benefit is needed. Okay. Actuarial assessment, at the end of each year it has to be taken. The assumptions, the actual gain loss will be calculated at each balance sheet date. Okay, each end of the year, and must be reassessed. Assumptions should also be reconsidered. If there is any change, then the impact of such should also be considered. If there is any material change, then defined benefit shall be remeasured. A change in liability due to remeasurement shall be treated as actuarial gain loss. If any difference arises due to such change in actuarial assumption, such impact will be considered and the difference amount will be considered as actuarial gain or loss. Transferred to OCI. What is OCI? Other comprehensive income, part of P&L. Past service cost is an entity shall remeasure the defined benefit liability with new terms of defined benefit plan. Okay, past service cost. Incremental cost related to period for which employee has already rendered services. Okay, means services given. See what it is? Means services have been given, payment pending. It might be that payment is pending. See, read this again. Incremental cost related to period for which employee has already rendered services, and now from retrospective basis the amount is increasing. Okay, at times the government employees are there and their wages increases retrospectively from last 1 year, last 2 years. Okay, if this is happening, payment pending, what? The incremental, the raised, the payment that has been increased, then incremental payment is pending. Past service cost does not include what? Difference due to change in actuarial assumption. Actuarial assumptions and difference due to that is included in actuarial gain loss. Underestimation or overestimation of discretionary pension by entity. Okay, any underestimation or overestimation is not included under what? Under past service cost. Estimated benefit improvement that result due to actuarial calculation recognized in PL account. Increase in vested benefit. Vested benefits means cash entitled for the leave, example sort of, or any amount that is entitled to the employee, that whenever he will retire or whenever he will leave the organization, then such payment is entitled. Absence of new benefit employee completing vesting requirement. Such amounts will not be considered under past service cost under P&L. Conclusion. Past service cost arise only when contractual benefits are increased. Okay, very important. Okay, if any increment in the employee benefit is done retrospectively, then only past service cost word arises. Okay, otherwise, other than this, nothing will be recorded as past service cost. Example, year 1, year 2, year 3, year 4, year 5, it was 20% of final salary initially, but from year 3, it decided that 30% of final salary, so 10% is increment. Then what happens? 1 lakh, originally it was 1 lakh into 20%, okay, as agreed. Now further, now it is 1 lakh into 30%, okay, the further it will be recorded as 30%. Such amount, that is 10,000 difference, will be recorded as past service cost. Curtailment or settlement. Curtailment means stopping, settlement means paying off finally. Curtailment and settlement shall be accounted in the year in which it occurs. Reduction in defined benefit liability or increase in defined benefit liability shall be accounted immediately. Any reduction or increment in liability obligation will be recorded immediately. Either automatically transferred to OCI, if not then PL account. Okay, either automatically it should be transferred to other comprehensive income. For example, if it is not, then you can transfer it to P&L if such difference arises. Payment of defined obligation plan amount should be paid is reduced from liability. Any amount that is paid, what you will do is you will reverse the liability, or you can say obligation will be reversed and debited, and to bank will be done if paid or any other thing. Okay, cash. Plan asset means any asset that has been specifically parked to meet up the obligation as and when arises in related to employee benefit. It is a fund created by entity for payment of employee liability. Only those assets qualify for plan asset which can be used for payment to employee. Okay. Following assets qualify for plan asset: insured benefit, state plan, multi-employer plan, group administrative plan, etc. If such fund is assigned in such plans and kept separate and for the purpose, and its purpose and intention is just to meet the employee benefit expense or obligation when it arises, then it can be considered as plan asset. Fair value of plan asset is calculated by actuary. Difference on remeasurement is transferred to other comprehensive income. Presentation, disclosure and other details. Presentation in balance sheet, we have non-current liability. Here under this you will see closing defined benefit obligation. Okay, it can be asset, it can be liability. Okay, or net basis. This is done on net basis. Okay, whereas PL account, you have seen current service cost, interest cost, past service cost due to any increment, and OCI. Okay, and remeasurement of gain loss, that is actuarial gain loss. These 5 items are recorded under P&L A. Curtailment gain loss is automatically transferred to other comprehensive income. You have to learn this, that when it goes to OCI and when it goes to P&L. Okay, you have to learn this. Keep in mind. If entity has plan asset, if entity has not plan asset, then curtailment gain loss will be transferred to PL. Okay, you got this? Whenever any organization has plan asset to meet the employee benefit obligation, then such amount difference on remeasurement will be transferred to OCI. If no plan asset, then it will be transferred to P&L. See, read this again. Make this very clear. You have to learn this. Okay, when it gets transferred to OCI and when it gets to P&L, because that is very important question. And at times case studies come and you have to just pick up the right case. Okay, you have to understand this and apply this provision. Net interest is what? Opening defined benefit liability minus opening plan asset comes net liability. Interest net liability into discount rate. Here comes the interest amount, that is interest cost. Curtailment means what? Significantly reduces the expected years of future service of current, means stopping the employment. Eliminates the accrual or defined benefit plan for some or all future services. Okay, in total, curtailment means what? It reduces the obligation or liability, you can say, and it might be due to stopping the employment. Remeasurement of gain loss on liability. Okay, opening liability, this is a format. Learn this. It will help you in solving organization. Opening liability, okay, current service cost, interest cost, past service cost, benefit paid to retired employee, reduction due to curtailment, actuarial gain loss. This will be balance in figures, and closing liability, you have got it. This is what? Balance in figure. Now whatever the balance in figure is there, this will be transferred to P&L. Remeasurement of plan asset, opening plus cash asset payment made, benefit withdrawn or withdrawn for retiring employee, withdrawn for curtailed employee, interest income, and then balance in figure will be actuarial. You have a closing value, you have a opening value. The difference and any addition done or withdrawn done will be done. Any difference that arises will be considered as actuarial gain or loss. Remeasurement gain or loss will be netted. Okay, this will be shown as net in P&L. Disclosure is required for actuarial assumptions. Disclosure is required for type of plan assets. Both are required. Long-term employee benefit, accounting and reporting is same as post-employment benefit, because you know that we have studied, if not paid within 12 months then it is short-term, and if paid within 12 months, after 12 months, then long-term employee benefit and termination benefit and post-employee benefits, okay, are accounted on same basis. That is, complex accounting is there, actuarial techniques are implied. So we have learnt about post-employee benefit, and now long-term employee benefit accounting is also done in a similar way. But remeasurement gain loss is always transferred to P&L, whereas here it was what? If it has plan asset, then it goes to OCI. If it does not have plan asset, then it goes to P&L. This is one difference, one major difference. Termination benefit, similarly, when employee accept termination, otherwise employer has right to terminate employee. In both the cases, termination benefit shall be accounted when following conditions are satisfied. Present obligation from past event, outflow of benefit is probable, okay, you have to pay, there are high chances, reliable estimates of amount can be made. If three of these conditions can be made, are satisfied, then accounting of termination benefit will be undertaken. If it is payable within 12 months, then according to short-term employee benefit. If such termination is payable after 12 months from the balance sheet date, then it will be recorded in a similar way to long-term employee benefit. Entire termination benefit shall be directly recorded. Okay, that's all for Ind AS 19 and employee benefit. I hope this is clear. In case of any doubt, please reach out to us, comment down below, let me know. If you like the video, if you found it helpful, then please hit the like button. See you in the next video. Till then, take care, be safe, stay tuned.